Welcome to the Fall 2020 Area Real Estate Advisors Market Update. My name is Brett Benjamin, Director of Analytics at Area, and I will be guiding you through today's presentation. Today's presentation is really broken up into 5 parts. First, we will touch on the national economy, and then we'll go into the 4 commercial real estate property markets in the KC metro area. So one of the things we need to start with is the labor markets. So as we've seen coming out of the lockdown and into the spring, summer, and into the fall, we've seen a nice economic bounce from where we were in early spring. And what we are seeing right now is a very fragile V-shaped recovery. We can see that in the GDP numbers that were just printed this week at a 33.1% print. That is a very strong rebound in the third quarter for the US GDP. So what we are is a very fragile V-shaped recovery. However, given where the path of pandemic is going and the rising number of cases, many have said that that recovery could stall and we could be in a longer W-shaped recovery. I think putting a shape on any type of this recovery is really hard at this point. There are a lot of unknowns. But right now, what we think is we're in a very fragile V-shaped recovery, and we're going to get a lot of these unknowns hopefully clarified in the next 6 to 12 months. But one of the things we look at that's most important is the labor markets. The labor markets, if you think about it, drive consumption, which helps drive GDP and economic activity. So as we've seen going into the lockdown during this unprecedented time, a massive number, a record number for modern times of people filed for new weekly unemployment claims, over 6.5, close to 7 million for several weeks. Now you can see in the chart at the top left, we have significantly dropped down, and that is wonderful. The week ending October 17th, we printed 787,000 K of new weekly filings. A significant drop from where we were in the lockdown and in the early months of the pandemic. However, if you look to the left on that chart and look at January, February, and March, pre-pandemic, we are significantly higher. So the unemployment rate in the United States is still high. It's around 7.9%, and that still shows a lot of stress in the labor markets. Cumulative claims, which we're showing on the chart to the bottom, have come down significantly from where they were at their peak, but they're still at about 8.37 million on the last print. That's significantly still high relative to historical context, as you can see in the chart. There is stress in the labor markets, and this needs to be watched as it is very important to the economic recovery. As we move forward, again, I want to point out something that we're following, and that is that long-term unemployment continues to rise. So if you look at the first chart on the left, and you look at the yellow line, that represents people that have been unemployed and filing claims 27 weeks and longer. That was pretty steady until we hit September, and now that number continues to rise. We're also looking at the dark blue and light blue line that represent 15 to 26 weeks and 15 weeks and over. Both those are still remain pretty high. So what we're saying is essentially those that were quickly furloughed and laid off and then came back to work once the lockdown was over, that number, as you can see in the far left, has come down. But those that were laid off and furloughed that have not come back to work is consistently remaining high and somewhat rising, and that is alarming. If you look at the chart on the right, we're going to see total U.S. employment. You can see where we were in February and the significant drop down into the crisis, and where we were in September. Again, very important to understand where the economy is going. Now, on a positive note, if you look at where the Fed is looking at GDP growth and our GDP outlook, this was September 2020, you can see in their latest projection, which is in the yellow, that they predict better GDP growth, in a sense, a less of a decline in our economic activity for the full year 2020, compared to where they were seeing in June, which is in the blue. So if you look at the GDP outlook by the Fed, we're saying that economic activity will decline in 2020, but we don't think it's as bad as we first thought, and we think that we will rebound in the following years. So as we move into the commercial property markets and we look at some of the forecasts, I think it's just important to understand what these forecasts represent. We are using COSTAR and Oxford Economics, and we are using their base case scenario. So what I want you to understand about the base case scenario is it anticipates a V-shaped recovery, which basically means with a positive outcome in the search for vaccine, and it leads to a return to normal economic activity at some point later in 2021. This is the case we're going to use moving forward. So as we move into the first commercial property market, which is the retail market in KC, we're going to go over the market stats. So obviously, retail has been hit the hardest both across the country and in the KC market, and you're going to see that in the stats. So first, what we're looking at is market rent growth year over year, and that continues to gradually decline. We were at 3.4% in Q4 of 2019. Right now, Q4 2020 quarter to date, we're at 0.7%. And in the base case scenario, COSTAR expects that to eventually turn negative in Q1 of 2021. Further, vacancy rates are slightly up from beginning of the year, about 40 basis points. We were at 5.2% in Q4 of 2019. Right now, we're about 5.6%. Again, COSTAR estimates in their base case scenario that is going to be up to 6.2% sometime in Q1 of 2021. Another thing to point out, vacant square feet is up about 8.5% year over year. Sublease space, something we're watching very closely across all markets, is up 34% year over year. And then again, sales volume in terms of investment activity in the capital markets down significantly, around 49% year over year. Something to keep an eye on, but obviously not completely abnormal for what we're seeing in the market. As we look at the capital markets quickly in this overview, we're going to see it to the left, on the top left, the market sale price per square foot over the last 10 years, similarly market cap rate, sales volume, and 12-month sales volume growth. You'll notate the decline in sales volume year over year and that decline in sales volume growth. As we just talked about market rent growth, we're going to see in this chart, for brevity and simplicity, focus on the red line. That is the Kansas City market as indicated below in the chart. We can see market rent growth coming down as we entered the pandemic, dropping significantly, and then rebounding here later in the year. And as we move into 21 and 2022, a rebound in market rent growth. But as I mentioned, we're going to maybe see negative rent growth in the first start of 2021. Further, as I mentioned earlier, retail market vacancy rates. Again, here, focus on the red line. A small dip or increase in vacancy rates as we went into the pandemic. COSTAR is forecasting that to go up and then trend up consistently for the next few years. And I think that's something to keep an eye on. Again, 6.2% to 6.5% over the next 1 to 2 years is their forecast. Finally, in terms of sales volume, we talked about this, sales volume down significantly. We're about 160 million year to date. That's about half of where we were last year. So where we end up, maybe 3/4 of where we were last year. Not sure on that yet as we haven't hit the year end. But sales volume, as you can see over the last on this chart, down significantly. So as we move into the multifamily market, again, we're going to hit the multifamily market stats. I think it's important to see an overview of what we're showing. So sales volume is down from pre-pandemic levels. But interestingly, we had a very strong Q1 2020 before the pandemic. So 2020 sales volume, because of that record Q1, which I'll show you in a second, is up over 2019. But if you look at the next few quarters, sales volume is down significantly. So right now, 12-month sales volume is down 20.5%. And this quarter, we're really only about 1 million right now, quarter to date. That's significantly down from prior quarters. You can see that enormous blowout Q1 in 2020 was around 460 million in sales volume. Market cap rates are stable. One thing we are looking at is an interesting discrepancy in vacancy rate. So overall market vacancy rates are about 95% increase year over year. But higher end properties, as you can see on the right, are showing an increase in vacancy rates, while actually lower end properties remaining range bound. So if you look at that right now, overall market, 7.5% vacancy rate in Q4 of 2019. COSTAR is saying right now we're about 7.9%, estimating in 2021 that moves up to 8.8%. But if you look at the 4 and 5 star, significantly higher starting point in terms of vacancy rates, and then significantly more of an increase into 2021. 3-star product is actually pretty stable, and it will shows remaining stable in their forecasts. It's an important discrepancy and one we're following. As you look into the capital markets, what I want to point out again is sales volume is up. If you look at that on the bottom left, it's up for 2020 over 2019, again to the huge Q1 numbers, But if you look at 12-month sales volume growth, 2020 right now is barely positive and may turn negative. Finally, we look at what we call our SDV chart, sales, deliveries, and vacancies. What I want to point out here really is just a strong both deliveries and absorption we saw really in 2020, and what is forecasted to be somewhat of a drop-off in both moving forward. Finally, we talked about sales volume, and I showed you a number of charts. This is just an easier way to look at it, and you can see quarter by quarter the massive drop-off in sales volume in multifamily, not expected as people are somewhat pausing on the uncertainty in the market, something we're following, but we do expect activity to pick up late spring and into the summer as we hopefully get a hands around this virus and economic activity picks up and more clarity in the capital markets. Finally, multifamily vacancy rates, and we talked about this dispersion. If you just focus on the green line, that is the overall market, you're going to see a slight increase, was about 95 basis points year over year, and you can see that in the forecast we're going to increase slightly before returning over the next few years. Look at the blue line, that is higher quality products, 4 and 5 star, that would be your A class product. That vacancy rate increased significantly and continues to in the forecast before declining in 2023. Below that, the 3-star product, maybe the B product, the B and C product, is showing much more stability during these times. So as we move into the industrial market, obviously we talked about retail multifamily, retail getting the brunt of the impact from the economic recession, the lockdown. A lot of those industries are still suffering severe stress. Industrial is not experiencing that same phenomenon. In fact, they're experiencing the opposite. We're seeing a lot of demand, especially from this secular rotation that has been increased for e-commerce and distribution. Industrial market is showing a lot of strength. There is more increased need by e-commerce distributors for closer distribution and logistics, and we're seeing that in the stats. So first of all, vacancy rates remain stable post-pandemic, down about 20 basis points year over year, really nothing. COSTAR actually estimates only 10 basis point decrease from before the pandemic in 2019, where we are in 2021. Construction starts remain stable and strong. We're up 2.096 million square feet in Q3, a really strong number. Square feet under construction is up 153% year over year. So there's a lot of money and effort being moved into building out more inventory in this market. 12-month sales volume is down 55 basis points. That's not a huge number. It's, again, depending on which market, investors have paused as they look for more clarity in the capital markets. The other thing I'd point out is market rent growth, 3.3% in Q3, very strong. COSTAR is going to forecast a decline in the first half of 2021 with a rebound in the second half. Again, vacant square feet is down 2%. Sublease square feet, where we're seeing massive increases in other markets, is only up 12.4%. So I think what we're really seeing is an overall strong picture of the industrial market. In the capital markets, you'll notice sales price per square foot continues its nice trend upwards. Cap rates are somewhat stable. Sales volume down a little, but we expect sales volume to increase in 2021 and moving beyond. Finally, look at our sales delivery and vacancy chart. We're really, what we think in the forecast is stable absorption and deliveries and stable vacancies. I pointed this out about that really strong 3.3% number. If you just focus on the yellow line, which is the Kansas City market, market rate growth in Q3 was 3.3%. While there is a drop off here in the forecast into 2021, there is a nice strong rebound into 2022 and 2023. Finally, in terms of construction starts, which we mentioned, 2.096 million square feet in Q3. We're seeing a much lower in Q4 year to date, but we expect this to continue to be strong in the next few years. And finally, the office market being one that tends to lag in terms of its abrupt reaction to economic activity or economic disruptions. The office market rent growth is not been great, but it's pretty much range bound and stable. So we saw 2.6% in Q4 of 2019. Right now we're about 0.2%. So market rent growth is somewhat minimal or marginal. COSTAR does estimate we moved negative 2.9 somewhere in 2021. One thing we're noticing is that rent growth of 0.2% for the KC market is actually slower than some of the comparable metro areas. We're not sure what the reason for that is, but there's a little bit higher growth in St. Louis and Des Moines right now. I would say, again, if you look at the capital markets, all but industrial sales volume is down 76% year over year, again, due to investors looking for clarity in the economic and capital markets. Vacancy rates have slowly crept up about 140 basis points to 8.5%. If you look at the daily rate, right now it's about 8.64%. They're going to remain somewhat range bound, but the estimates do show us moving above 9% into 2021. Vacant square feet up about 23%, and something again we're following across all markets. Sublease space for office in KC is up 53%. So we move into the capital markets overview. This is the same 4 slides we saw for all markets. Sales volume is down. We've seen a little bit of a change in cap rate over the last few years, but it's somewhat stable right now. Really, somewhat similar picture to some of the other markets. The office market STV chart, sales, deliveries, and vacancies. We can see the rise in vacancies in the Kansas City metro area. Interestingly enough, right now net absorption in the office market is negative, and it's going to forecasted to stay negative for the next few years. Deliveries have been positive this year, but are expected, except for Q2, to drop off. So that's just a means of where the market is and the dynamics of what's being under construction and what's been delivered. I mentioned market rent growth, where we saw a slow decline during the pandemic and into the end of the year. It's expected to decline further, but then rebound into 2022 and 2023. This is range bound. These are not huge moves, but nevertheless, market rent growth may turn negative for 4 to 8 quarters. Finally, vacancy rate. We're seeing that vacancy rate is for the Kansas City area in green versus the 3-star product and the 5-star product. A somewhat of a minimal increase, around 140 basis points year over year, but we see that while it continues to rise in the forecast, it's stable. So that is promising to us. If vacancy is going to increase, we're expecting that, but if we can get a stabilization in those vacancies, that we can eventually bring that down. That is the end of our presentation, and thank you for watching it. We appreciate it.